What happens to your investments if your brokerage collapses? Maybe it goes bankrupt like Lehman Brothers in 2008. Or maybe there's geopolitical trouble because Trump starts a fight with the EU or because Russia attacks Eastern Europe. As an investor with 18 years of professional experience, both on Wall Street and here in Europe, I'm getting a lot of questions about brokerage safety recently. So in this video, I'll show you how European brokerages keep your money safe, when these financial or geopolitical risks can become a problem, and what I'm doing to stay protected. Alright, so historically, a licensed brokerage has been a very safe place to hold your money. In fact, it's a lot safer than your typical bank. In the big financial crisis between 2007 and 2011, hundreds of banks around the world went bust. A lot of people lost their savings. By contrast, very few brokerages collapsed. And those that did, like the brokerage arm of Lehman Brothers, usually failed because they were part of a bigger firm that got into trouble. And in most cases, investors lost nothing or very little. To understand why that is, let me explain the difference between how a bank and a brokerage operate. So, when you deposit 50,000 euros in a bank, that money becomes an asset of the bank. The bank can now use your money to make a profit, typically by lending it out or by investing it. And this exposes banks to two major risks. First, what if the bank makes bad loans to borrowers who cannot afford to pay it back? Or what if the bank buys some investments that do poorly? Soon, the bank may not have enough money to cover client deposits. The second risk is a bank run. This is when many customers get scared and demand their money back at the same time. This is a problem even if the bank has only made good, responsible loans or investments. Because most of the bank's money is tied up in these kinds of long-term assets, it simply can't come up with the cash fast enough, and the bank collapses. If your savings are below the deposit guarantee limit, which is 100,000 euros per client per bank here in Europe, that's not a big deal. But if you've got more sitting in the bank, your money is at best frozen, and at worst, it can be lost for good. In practice, these two risks often combine. This is what happened to Silicon Valley Bank in March 2023. This American bank announced that it had lost a lot of money on bond investments, and following this news, its big customers got spooked. They immediately tried to pull out billions of dollars, and within 2 days, the bank was history. By contrast, these same two risks don't apply to a brokerage at all. When you send money to your brokerage, they don't use this money to make loans or investments. Instead, the brokerage holds the money on your behalf, almost like if you put it in a safety deposit box. And when you use that money to buy stocks or ETFs, you decide what to buy, not the broker. This means that if you make bad investments, the losses are yours, not the broker's. So there's much less risk of a broker failure because of bad investments or bad loans. And there's no bank run risk either. I mean, if many brokerage clients want their investments back at the same time, there's no problem because it's all sitting there. Now, of course, like any company, a brokerage can still go bankrupt. For example, maybe the brokerage is part of a bank, so when the bank fails, the brokerage does too. Or maybe the brokerage simply doesn't have enough clients to cover its costs. But even in those cases, client investments are safe because they are held separately from the brokerage's own money. Okay, so this is true whether the brokerage is part of a bank or whether it's a standalone company. If your broker fails, your stocks or ETFs eventually get transferred to a different brokerage. It may take some months, it could be stressful, but in the end, you'll be fine. At least that's the theory. In practice, sometimes theory fails and investors lose money. In most European countries, government guarantees only cover 20,000 euros per client per brokerage firm. So the coverage for your investments is much lower than the coverage for a bank account. So if your losses with a brokerage firm are bigger, you could be out of luck. In a minute, we'll look at how this can happen because of geopolitical risks. But usually, the risks are much more basic. The first big risk that you need to be aware of is fraud and theft. In 2012, American commodities brokerage Peregrine Financial Group went bust when it was revealed that the CEO, Russell R. Wassendorf Sr., had been stealing client money for years. Wassendorf was the author or co-author of 6 books about trading. He was involved in charity. He had won a number of awards for contributions to the community. So this illustrates how difficult it can be for outsiders to recognize fraud. In the end, customers of Peregrine Financial Group recovered less than half of their money. The second risk is misuse of client funds. The management or rogue employees of a brokerage sometimes use customer funds not to get rich themselves, but simply to try and save the firm from collapse. This is illegal, but in times of tremendous pressure, the temptation can be difficult to resist, especially if the brokerage has poor internal controls. A famous example is MF Global in 2011, which misused around $1.6 billion in client money for its own needs. After a long investigation, there were no criminal charges filed against MF Global or its officers, like the CEO, John Corzine, a prominent American politician and financier. Although Mr. Corzine was fined $5 million for his role in MF Global's collapse. So basically it appears that in this case there was no malicious fraud, but customer funds did get misused. MF Global also illustrates the third brokerage risk, which is technical incompetence. It turned out that the brokerage's internal controls were so bad and bookkeeping was so disorganized that the broker didn't even realize any client money was missing for way too long. And that is a major problem. If you own some stocks or ETFs at a brokerage, you're basically counting on the brokerage to keep track of which investments belong to you and which belong to other clients. And if these internal records are messed up, it could be impossible for you to prove that you actually own your investments. In the end, MF Global customers did get their money back, but this took years. And this highlights the fourth risk: the time value of your money. If your savings are frozen for years, these are years that you can't use the money to invest or earn a profit, or even to pay rent and put food on the table. Finally, risk number 5 is bankruptcy expenses. Investors can end up losing money because the process of a brokerage bankruptcy costs a lot. For example, after currency broker Alpari UK collapsed, well over $10 million in various expenses were taken from client funds. They were paid to lawyers, to auditing firms, to IT companies, and others involved in shutting down the company. So these are the 5 major risks, which are actually the most likely to cause problems for brokerage clients, at least in normal times. Yes, brokerages are safe, but sometimes because of these problems, you have a risk of losing money. So this is why it's important to choose brokerages with a good reputation, with solid financials, with high technical competence. That said, we are arguably not living in normal times right now. So let's go ahead and look at some geopolitical risks and how those could affect your brokerage account. Risk 1 is war in the country where your brokerage is based. Especially here in the Baltic states, people often ask me, what happens if our country gets invaded? And my answer has 2 parts. Well, first of all, I really believe this is a low probability event. I don't expect war to break out within the EU or within NATO countries. That is why I personally have substantial investments with local brokerages like Swedbank and Lightyear here in the Baltics, although we are right next door to Russia. But second, if war does happen, well, let's be real. There are no guarantees about what happens next. You cannot be sure that banks and brokerages will function normally. Assets can be confiscated, financial systems can be shut down or sanctioned. Back in World War II, one stock exchange closed after another, meaning that even if your broker still continued operating, you wouldn't be able to sell or withdraw your money. Basically, in the case of outright war, don't count on your local bank or brokerage accounts, okay? So this is why, in addition to my local accounts, I have opened a number of brokerage accounts in different European countries. In a second, I'll go into more detail about that, but first, let's move on to another geopolitical risk, which is sanctions. When Russia invaded Ukraine, Russians living within their own borders largely remained physically safe. War was kind of a distant reality, similar to how it was for Americans when America went into Afghanistan or Iraq. But for Russian investors, it was a different story, because when Western countries put sanctions on Russia, investors holding foreign stocks through their Russian bank or brokerage found their investments frozen. And while in theory there is a process to unfreeze these investments, in practice it's close to impossible. Now, to be clear, the Russian invasion of Ukraine is a crime, and in my view the sanctions are justified, but from a regular investor's perspective, this clearly shows how geopolitical events outside of your control can affect your brokerage account. It can be hard to imagine how this could happen if you hold investments through a brokerage in a major Western country, like Saxo in Denmark or the Giro in Germany. But when Trump threatens European countries over Greenland, this possibility suddenly doesn't seem quite so impossible. The third geopolitical risk is confiscations. In recent decades, this has not been a major issue for investors. But during World War II, many countries, including the US and the UK, confiscated investments belonging to investors in enemy countries. So, if your country seems to be at risk of going to war with country X, you might not want to invest too much in country X, or you risk losing your investments completely. The fourth geopolitical risk is punitive taxation. In 2025, the Trump administration threatened higher taxes on European investors. This was ultimately never passed into law, but the message is clear. America is open to using taxation to pressure or punish Europe, and it could do so again. Finally, the fifth geopolitical risk to discuss is investing through a brokerage that is headquartered in a potentially unfriendly country. I don't have clear historical precedents to point out here, but a lot of people have asked me about Interactive Brokers, which is an American brokerage firm. If relations between America and Europe get worse, could this be a problem for European investors? Well, on the one hand, European investors are actually served through Interactive Brokers Ireland and Interactive Brokers UK. These are formally brokerage firms that are legally established and licensed in Europe. Okay, these companies have local management and they are bound by local laws. They are regulated by local regulators. But on the other hand, while I don't have direct knowledge of the matter, I would guess that Interactive Brokers is quite dependent on the technology, the infrastructure, and leadership of its American parent. And similarly, how we can be concerned about potential Chinese influence on the West through TikTok, it is hard to ignore the American influence in this case. At the end of the day, is this a major problem? For me, it's hard to imagine a realistic scenario where American and European relations get so bad that an American brokerage would harm the interests of its European clients. I myself have a significant part of my family's wealth invested through Interactive Brokers, but is the risk zero? Probably not. All right, so these are the geopolitical risks that I see with our brokerage accounts. But what should you do with this information? First, stay calm. All these risks describe low probability events. Don't lose sleep over them. As Mark Twain said, I've lived through some terrible things in my life, some of which actually happened. Second, consider diversification. Start with portfolio diversification. You probably don't want to keep all your money in the S&P 500 unless you're a huge fan of the American market and you're comfortable exposing your entire portfolio to what happens in America. And then consider brokerage diversification. I don't want to keep my entire portfolio with one brokerage based in one country. In fact, I'm using multiple brokerages based in Ireland, Germany, Denmark, Cyprus, and Latvia. If you're just starting out and investing your first 1,000 euros, that's overkill. You probably don't need it. But as your portfolio size grows, I think it's only sensible to spread out your wealth a little bit across 2, 3, maybe more different brokerage accounts. Which leads me to the natural next question. What are the best investment apps or brokerages to use for European investors? This is actually quite a tricky question because you have to consider multiple factors: safety, fees, product access, taxes, and more. So if you're interested in finding a good brokerage or investment app for your own money, watch this video next, where I cover some of the best brokerages in Europe and how to choose among them.